Okay. Now, very basic revision, because these terms we are going to use frequently. Spot price, the price of the underlying asset. It may be an index, it may be of stock. So the market price of the underlying asset is known as spot price. A strike price is the price at which we buy the option or sell the option, is known as strike price. A strike price may be higher than the spot price, it may be lower than the spot price. And the price we pay for buying and selling the options, for buying the options, is known as option premium. So option premium is simply the price of buying the option. Every option is having a fixed maturity period. Especially in European options, the option will mature at a specific date, which is normally in the stock market, it is the Thursday of the week or Thursday of the month. There are two types of options in Indian stock market, either the stock options or the index options. Two index options are very popular, like NSE Nifty and Bank Nifty. Stock options means the option of the stocks, the Reliance, or there are many companies which are very liquid in derivative market. We have two kind of options, call options and put options. Call options, option to buy; put option, option to sell. If you have bullish, then buy call option. If you think the market is bearish, then you can buy put options. American and European options. American option, you can execute the option on any day before the expiry. American option, you can only execute the option only at the expiry day. There are three positions in the options: in the money, out of the money, and at the money. In the money means the option is already profitable. Out of the money, the option is in loss, so will not be executable. You cannot execute the options. At the money, no profit, no loss. So the strike price and the market price is the same. And then we are having the 5 relationship. So we will discuss the relationship slowly and slowly. Now, I assume that all of you have clarity on these terminology. In case if you don't have any clarity, you can ask. So assuming that you have understood all the basic terminology of the options, now I'm telling you the factors which are affecting the stock prices, the stock options or index options. Because all the models which are built on the options are based on these 6 factors. The first factor is current stock price, current price of the underlying asset, that is represented by S0, a strike price, then time to expire, maturity, the volatility of the stock price, risk-free interest rate, and the dividend expected during the life of the option. Now the question is that what is the relationship between these factors and the option prices? So if we talk about the stock price, so you can see that this is the summary of all the impact. So first let me discuss the stock price. If the spot price of the stock or the index increases, the call will increase, put will decrease. So whether it is a small c means European call, capital C means American call, European put, American put. So there is no confusion with respect to the spot price. If spot price increases, call will increase. If spot price decreases, put will increase. In case of increase spot price, call will increase, put will decrease. In case if spot price will decrease, put increase, call decrease. So this is the clear relationship between the spot price and the option prices. Second, and the rate of change of option price with respect to spot is known as delta. So this relationship between the spot price and the option price is known as delta. And this relationship is one of the source to hedge. And if you are hedging your portfolio according to the delta, this is known as delta hedging, and which is quite popular type of hedging in the market. For example, suppose you are maintaining a portfolio, you know that the portfolio value changes every day, and you have a problem that whenever the market will go down, your portfolio value may come down. So now the question is how to hedge. So you can hedge the portfolio by different strategies. The simple strategy is buying put. Other strategy is covered call. So there are many different strategies that where you can save your portfolio. The second is the strike price. Obviously, if you change the strike price, there will be change in the call price and the put price. If you increase the call price, if strike price, sorry, if you increase the strike price, the call price will decline and the put price will improve. Why? Because if you increase the strike price, it is out of the money call, so the call price will decrease. And if you increase the strike price, it means put is now going in the money. So therefore, put price always increases. And the third is the time to expiry. So normally the time to expiry is very clear. If time to expiry is far, it means there is a more uncertainty in the market, and more uncertainty, due to more uncertainty, the price of the call and put is high, whether it is a American call or it is a European call. It is same for both. So time to expiry increases the price of the call and put. The fourth is volatility, which is changing day by day. There are different type of volatility, and normally we talk about the past standard deviation of the returns, which is indicating the historical volatility. But in the stock market, we are not talking about this. This sigma is basically volatility, but it is represented by the implied volatility. So implied volatility is changing the price of the call and put, and implied volatility is calculated from the out of the money put options and out of the money call options. And you know that in Nifty, you can see one of the index, that is VIX. So VIX is simply the measurement of implied volatility. So implied volatility is impacting the call and put prices. Normally, when the volatility is less, the call and put price is low. And when the implied volatility is high, sorry. Yeah, implied volatility if high, then the price of the call and put is high. So this relationship is known as Vega. And the rate of change of the delta is known as gamma. So we are having the delta and gamma hedging also. The volatility is playing a very, very important role in deciding the call and put prices, because you have already learned the Black-Scholes model. In Black-Scholes model, there is a one applied formula derived from Black-Scholes model, that is known as KMV-Merton model. So KMV-Merton model is calculating the distance to default. I hope you heard about that. So distance to default. Normally, when you calculate the distance to default for a company, I'm telling you the major factor causing the distance to default is the volatility. Because of the volatility in the stock prices or in the revenue of the business, the valuation of the company will change. So if a company is having the stable profits, the valuation is more clear. And if the valuation changes frequently, then it will create, or it will have an impact on the distance to default, that is measured by D2. Similarly, we are having the interest rate. If interest rate increases, so there are two point of view from the literature. So one point of view say that the because of the increase in the risk-free return, the value of the call and put price should increase in general. But there is another point of view. The another point of view say that if there is an increase in the risk-free rate in the market, so now the debt securities are more attractive as compared to equity. So it may be possible there is a fall in the equity market. So because of the expected fall in the equity market, the price of the call will decline. The price of the put will increase. This is the view that is coming from the literature. But theoretically, if we talk about theory, the theory say that because the risk-free interest rate increases, so value of the call and put also increases. So there are two thoughts for this. Similarly, we are having the dividends. Now, dividends is actually a dividend. The problem with dividend is that if on the X date, the equity price is reduced by the dividend amount. So when a company is providing the dividend and the dividend is quite high, then the stock price will come down. So it means if you are holding a call and you know that the X date is coming in the period, it means after that period, the value of the call option will come down and the value of the put option will go up. So this is the impact of dividend on the call option and the put option. So it is just a summary of the factors, how the factors are influencing the option prices. So one more thing I want to show you. So it is a document which talk about the impact. So these are the factors which are influencing the option prices. And because of these options, we are deriving the 5 type of relationship. So these relationship are delta, gamma, vega, rho, theta. So just for definition, delta is the rate of change of option price with respect to spot price. Gamma, this is the rate of change of option price with respect to this is the rate of change of delta with respect to spot price. It is a second derivative. Gamma is the second derivative. Rho is the rate of change of option price with respect to interest rate. Vega is the rate of change of option price with respect to volatility. And theta is representing the rate of change of option price with respect to expiry, time to expiry. So these are the relationship which is causing the influence on the option price. And let's move from here. So the relationship I mentioned here, just one read on the slide. Call option increases in value when stock price increases. Put option becomes less valuable when increase in the stock price. Call option decreases in value when the increase in the strike price. Put option becomes more valuable with increase in strike price. All of the above apply to both American and European options. So this is constant. So these 5 sentences is representing the impact of the spot price and the strike price on the option price. So volatility is simply all option increases in value with increase in volatility. Impact of risk-free interest rate. Normally, call option increases in value because of the increase in risk-free rate. Put option decreases in value. So normally, theoretically, basically, increase in risk-free interest rate increase the call value and decrease the put value. However, the literature found that increase in R, right, will cause a decline effect on the stock prices, leading the value of call option down and raising the value of put option. So the literature is totally different for this. Okay. Future dividend, I already explained you. If the company is supposed to pay dividend in the lifetime of the option, the price of the call will come down, put will go up. So that the value of the call option is negatively impacted by the size of the anticipated future dividend, and the reverse holds true for the put option. So these are the factors which are causing the impact of call option and the put option prices. Now the second thing which we are going to discuss is
Sir,
yeah.
So I have a question. Why this dividend affects the call and put option? Because dividend is company giving to the stockholders. So what is the direct relationship? What is the effect?
Yeah. Actually, dividend, if you're holding a call option or a put option of a stock, you are not entitled to get the dividends. Dividend will go to the holder of the stock. So buyer of the option and seller of the option is not getting the dividend. It is not impacted by the dividend directly. However, whenever the company pay dividend on the X date, the price of the stock declines. So the call option prices and the put option prices is not actually impacted by the dividend. It is impacted by the drop in the price. And most of the companies, because you know that there are three types of companies in the market: high dividend payment, average dividend payment, and no dividend payment. And there are many companies which are very high dividend payment companies like HUL. All the FMCG companies are high dividend paying, ITC. So when these companies pay the dividend, even many government sector companies like ONGC, Coal India, BHEL, so these companies are paying good dividend. So whenever the dividend payment is very high, it reduces the price of the stock. And because of the reduces the price of the stock, the price of the call option will come down and the price of the put option will go up. So this is the simple relationship between dividend and the option prices.
Okay, thank you, sir.
Now the topic which I am going to take is a complicated topic. And why it is complicated? Because it is completely theoretical. There are two methods of teaching this topic. One with the help of derivation, and derivation is quite complicated. So I will explain you the concept of bounding the prices and put call parity with the help of a numerical. And if you just go through that numerical, all the concept will be clear. Because the book is all the books are explaining this topic in a very complicated manner. So let me explain in a very simple way. The major focus of this session is on bound, lower bound, upper bound of the call prices, and how to derive the call and put call parity from this equation. So this is the focus. Now the concept is, what is the maximum and the minimum possible price of an option? So what could be the maximum price and what could be the minimum price possible for an option? And this limit will help you in deriving a very important equation which is known as put call parity. So first we will discuss on the upper bound, and second we will discuss on the lower bound. Now the question is that what could be the highest and as well as the lowest price of the option? Okay, now tell me one thing before going to the example. I just ask you a simple question. So all of you are residing in the Noida nowadays. Suppose there is a commodity and the commodity is available in Delhi, produces by the Delhi. The price of the commodity in Delhi is 100 rupees. And somebody go to Delhi, take the commodity and sell in Noida. So the transportation cost and all these costs per unit is 5 rupees. So he will decided to sell at 110. Right. So my question is it possible that the price of the commodity in Noida is less than 100? Answer is no. Why? Because if the demand of the commodity in Noida is very poor and nobody is ready to pay more than 100 rupees, the seller will stop buying from Delhi and selling in Noida. So we can assume that the minimum price to sell in the Noida is 100 rupees. So it is the lowest price. Now, if you go to the higher side, if you sell to the 110, people will buy because they know that if we go to Delhi and buy the product, we can buy the product at 100 rupees and the transportation cost and all these costs will be 10 rupees around. So we are getting at 110 is fine, not a problem. But if the seller increases the price and increases the price to the level of 110, Then after that, what happens? There are so many businessmen come into the picture, looking at the profit, and will, as a result, the price will come down in Noida. So what is the meaning of giving this example? The meaning is prices must have some upper level, upper maximum level and the minimum level. Now we are talking about the two different markets. One is the spot market and one is the option market. The spot market is the market where the underlying asset is traded, and the option market is a market which is a derivative and its value is coming from the underlying asset. So the question is that how we can decide that what could be the maximum or the minimum value of the derivative. And it is very tricky question. Why? Because it is an imaginary kind of question. And practically you cannot see all these things in practical. So it is completely theoretical. So the way we have to understand is considering an imaginary condition. Okay, so we will the simple question is that what could be the maximum price of the option and what could be the minimum price of a option, whether it is a call option or it is a put option. So now I'm going to answer this question in my own way. The logic we are giving to this imaginary condition is arbitrage opportunity. So whenever the arbitrage comes into the picture, the price will be corrected. So assuming that there is no possibility of the arbitrage, what could be the maximum and minimum price in the market? Like for example, in the Noida example, the maximum price can go to 110 and minimum price can go to 100. Beyond this, there is an arbitrage opportunity. So similarly, in the option market, we have to find out where arbitrage opportunities are there. So the first concept, what could be the maximum price of a call option? Answer is that call option cannot exceed the price of the stock. Whatever could be the value of the stock, the option value cannot exceed the stock price. Suppose spot price is 100 rupees and you buy a call option, and at the time of the expiry, spot increases by so much amount. So whatever amount by which the spot price increases, we also know that call price also increases. But in its whole life, call price cannot exceed the spot price. So the upper bound for the call option is price of the stock. And if you understand why, let's assume an imaginary condition. Suppose spot price is 100 and call price is 110. So at this level, there is a very strong arbitrage opportunity. If you see these prices in the market, you immediately sell the call price at 110, buy the stock price just 100 rupees, and your 10 rupees is the profit. So call price cannot exceed the spot price because of this arbitrage opportunity. So we make a theory now. It is a theory now. So call price cannot exceed the spot prices. So we have to remember this concept, because beyond this, if call price increases beyond spot price, so it is a huge profitable condition. The holder of the options will sell the options, buy the stock, and make the profit. It is very, very imaginary kind of concept. So we make a theory that call price cannot exceed the spot price. So you have to remember and write down somewhere. Second, what is the maximum price of a put? Now the put cannot exceed, the put option cannot exceed the strike price. You know that whenever we are expecting the market to go down, the put price always increases. So whatever be the level of down, whatever be the level, the market will go down. Put price cannot exceed the strike price. It is the maximum level that put price can go. For example, suppose there is an imaginary condition that the strike price is 100 rupees, and because of the heavy market down, the put price is 110. And actually, I'm telling you, during the period of Corona, when the market was crashing like anything, the put price was very high. But even though in whatever way the condition comes in the market, the put price increases but cannot go beyond the strike price. So we put a theory that put price cannot exceed the K level, means strike price. And suppose this is the condition, then put is 110 and K is 100, K is 100 rupees. You just sell the put, invest this amount at a risk-free rate, and you are in profitable position. So that's why this condition is also not possible in the market. So now we are very, very clear that there is a upper limit of price, call price and the put price. Call cannot move beyond spot price, and put cannot move beyond strike price. And whenever you consider American option and European option, in case of European option, because you cannot execute the contract and in between, so we will take the present value of K, because K is the future amount, the amount, the level at which you buy, you have to right to buy and sell, but at the expiry date. So in between, you have only the present value of K. So we will use this concept. After that, now, after that, we have to understand the lower bound of the options, but it is too complicated. So I am explaining with the help of example, and kindly see this example carefully, because with the help of this example, we will derive the put call parity, and we will derive the lower bounds of the call and put. So let me explain you the example. The example is already in the PPT, but it is better if we solve it in front of you. And believe me, this example is very, very important. Okay, so you have to solve this example also. Now I'm creating 4 portfolios. Portfolio A equal to call option plus 0 coupon bond having the maturity at K. So this is the portfolio A. So I hope you can see it clearly. And then we are having the portfolio B. And portfolio B is equal to stock. So there are 2 portfolios. Similarly, we are having 2 portfolios here. Portfolio C. Basically, what I'm doing, I'm deriving the equations for call put parity. Portfolio C is equal to put option plus stock. And then we are having another portfolio, portfolio D. It is a 0 coupon bond. So 0 coupon bond are those bonds which are offered at a discount, but matured at par. So for that point of view, we assume it. And these 0 coupon bonds are giving you the interest rate of risk-free rate, that is RF. So we are having 4 portfolios now: call option with 0 coupon bond, and portfolio B, simple stock. Portfolio C, a put option and a stock. So we are having only one stock. And portfolio D, it is a zero coupon bond. Now I'm assuming the strike price that is K. So I'm assuming 100. Similarly, I'm also keeping the strike price 100 in this case also. Okay. Now there are three scenarios. A spot price is equal to 70 rupees. A stock price is equal to 100 rupees. And a spot price is equal to 120 rupees. So same example, same three scenarios I'm creating for the portfolio C and portfolio D. Okay. So we are having this example. Now, tell me what is the value of portfolio A here? And what is the value of portfolio B here? So we are required to calculate the value of portfolio A and portfolio B in all the three scenarios. Okay, now solve it. Portfolio A when the spot price is 70 rupees. So in this case, because the strike price is 100 rupees, spot price is 70 rupees, the value of the call option is 0. Plus, let me write here. So it is basically 0 plus spot price value is, okay. So call option is 0. Zero coupon bond K is 100 rupees because it is a coupon bond. At maturity, you will get 100 rupees. So the portfolio A will be 100 rupees. So the value of portfolio A is rupees 100. Call option becomes 0. Zero coupon bond is K. K means 100 rupees. Strike price. So the net value of the portfolio is 100 rupees. Similarly, portfolio B. In portfolio B, you are having only the stock. So
70.
The value of the stock is 70. Very good. And now this portfolio A in second scenario, the call option will be 0 and the K is also 100. So I am putting the 100 rupees because it is at the money. A strike price is 100. A spot price is also 100. So value of the call is again 0. And the zero coupon bond give you the 100 rupees. It will be 100. Similarly, the portfolio B is simply 100 rupees. You are having one stock in the portfolio B. So that gives you 100 rupees. Now, simply let's go into the portfolio A. So here the value of the call is 20. And so I can write 20 plus 100 equal to 120. So portfolio A is equal to 120. Because in this case, the value of the call will give you 20 rupees to 120 minus 100. 120 minus 100, the value of the call is 20. And zero coupon bond is giving you the 100 rupees. So 20 plus 100 is 120. Similarly, go to the portfolio B. Portfolio B is stock price. So stock price is 120. Its value is 120. Now I can write the conclusions here. So I can say the portfolio A is greater than the portfolio B. Similarly, here I can write portfolio A is equal to portfolio B. Similarly, I can write here portfolio A is equal to portfolio B. So can I write this? And because we take all the three scenarios, in the money, out of the money, and at the money. So this example is covering all the cases. So now I can generalize. So what generalization I can draw here? I can say that
When it is out of the money, you get portfolio A as better option. Otherwise, it's equivalent to stock purchasing stock.
that is also there. And but about whatever I'm going to prove, just listen this. So I can say the portfolio A is always greater than equal to the portfolio B. I can say this. Now, in other words, I can say I'm saying that. So what is portfolio A? I can say, okay, I have to type call option plus a zero coupon bond is always better than the stock. So this is my always, and I have to write the equal to also. Okay. Now, same thing I can say C is greater than equal to S minus K. Now, this is my answer. So what I'm saying that the call option is always greater than the S minus K. Call option is always greater than S minus K. So S minus K is the lowest possible value because it is equal to C is greater than equal to. So what is the minimum? What is the minimum value of call option? The minimum value of the call option is S minus K. And for a European option, we have to write e to the power minus RT. Because at any value of at any point of time, the present value of K can be calculated by this. So now we derive a very, very important conclusion that the minimum lowest value possible for call option is S minus K e to the power minus RT. So that is one of the important conclusions we want to draw. So this is conclusion number 1. Now we are moving to the conclusion number 2. So I derived the formula for the lower bound of the call option. Rather than explaining in a boring way from the book, this example I think is clearing you all the doubt. Similarly, I'm going to solve what is the minimum possible value of the put option. Yeah, Pragya is saying something.
Sir, I want to know what is the rationale behind considering only a zero coupon bond? Why can't it be like, with a coupon?
Yeah, because the strike price is 100 rupees. And the problem is that 100 rupees is a future value. Because in European option, you can exercise everything on the basis of the strike option, strike price. So strike price throughout the period of the option remains constant. A strike price is the only thing which remains constant in the whole price, in the whole option prices, right? And this is the amount which is a future value, basically, because whenever you are executing the option, you will execute at the strike price and a strike price will come, right? So we assume that the spot price, if increases with a risk-free rate, will move to the strike price, or if a strike price is very different away from the spot price, the present value is the present value of the strike price is the price through which we can compare the spot price. आज का जो स्टॉक प्राइस है उसको कंपेयर किससे करें? कल के फ्यूचर प्राइस से तो नहीं कर सकते. We cannot compare the today's spot price by the future strike price. So that's why we have to take the present value of the strike price, and that is the this K e to the power minus RT. This is the logic. Okay, now let's move to the portfolio C and D. So you just have to tell me what is the value of portfolio C. Portfolio C. What is the value of portfolio C? Now, so in this case, the value of the put is 30 rupees. 100 minus 70 because spot price decreases in this. In the first scenario, spot price decreases. Strike price is 100 rupees, spot price is 70 rupees. So value of the put option is 30. Stock value is 70. So we can write 30 plus 70 equal to 100. I hope it is clear now. Similarly, the price of the portfolio D, the value of the portfolio D. So what is portfolio D? It is a zero coupon bond. So at maturity, it becomes 100. So it is constant always for all the cases. So portfolio C is 100 rupees. Portfolio D is 100 rupees. In second case, the portfolio C is equal to the put option at this level becomes 0. The value of the stock is 100. So it is only 100. And the portfolio D by default, because it is only zero coupon bond, so it is 100. Similarly, in the third scenario, the portfolio C is put option becomes 0 because the market is moving up. Put option becomes 0. The stock price is 120, so it is 120. And the put option and the portfolio D value is 100 because it is a zero coupon bond. So now what conditions we can put here? That portfolio C is equal to the portfolio D. In scenario 1, portfolio C equal to portfolio D. And third case, portfolio C is greater than portfolio D. So by looking at all the scenarios, I can say the conclusion is portfolio C is always greater than equal to portfolio D. चाहे कुछ भी हो जाए, portfolio C हमेशा portfolio D के बराबर या equal रहेगा in all the scenarios. So whatever be the scenario, the portfolio C either greater than portfolio D or equal to portfolio D. Now how we can write it? We can write that put option plus spot price is always greater than equal to K. For a European option, it is present value of K. So, or present value of K. In American option, it is K, and in European option, it is present value of K. So this is the difference between American option and European option. In case of American option, you can always exercise the option only at the K. In European option, you cannot exercise in between. So at any point of time, K is the present value of K. Now, what is the conclusion here? Conclusion is that the put option is always greater than equal to. So we can take S in the right hand side. So I can write present value of K minus S. So what could be the minimum value of a put option? So what could be the minimum value of the put option? The minimum value of the put option is the present value of K minus S. So now we derive the lower bounds of the call and put option. So this is known as lower bound for call and put options. Actually, this derivation in books is very complicated. So I think with this example, it is easier to understand. Okay, now one more thing. So after deriving the lower bound for both call and put option, now I'm deriving one more thing. So similarly, I can write one sentence here that the minimum value of the put option could be present value of K minus S. Now I am deriving a very important concept that is called put call parity. Now, can you tell me which portfolio is equal in all the scenarios? Which four portfolios are same in all the scenarios? Answer is portfolio A and portfolio C. if you check portfolio A and portfolio C are having equal value. So whatever be the scenario, bearish scenario, bullish scenario, and same scenario, in all this scenario, is it true that the portfolio A and portfolio C are equal? Can we say the portfolio A and portfolio C are always same? Answer is yes. So when spot price is equal to 70, portfolio A is 100 and portfolio C is also 100. When spot price is 100 rupees, the portfolio A is 100 and portfolio C is also 100. When spot price is 120, portfolio A is 120 and portfolio C is also 120. So whatever be the scenario, the portfolio A and portfolio C is always equal. So we can write here. So from here, I am deriving one very important equation. Let me write the equation. So C plus K is equal to P plus S. So these two portfolios are always equal, whatever be the level of market. Whether the market will go down, whether the market will go up, the two portfolios will always give you the same result. Now, because this equation is more applicable with American options, if you consider the European option, this K will be the present value of K. So now we can write C plus K e to the power minus RT is equal to P plus S. So this equation is the world famous equation, which is known as put call parity. So I think by deriving put call parity by this example, it is easier to understand. So this equation is called put call parity. So now why the equation is important. So this is the normal question which comes in your mind. How this equation is important? This equation is important because if this equation don't hold, if this equation is not satisfied by the market, it means there is a arbitrage opportunity exists. So inequality of this equation, the left hand side and right hand side, the inequality of these two sides will give you the result of arbitrage opportunity. So before moving to the arbitrage opportunity, because of put call parity, you can ask any query. Yeah, Prayag.
Yeah, sorry, sir, I got disconnected. But I wanted to ask, what if my stock price is lower than the present value of the coupon? So in that case, my lower bound would be negative. So
yeah, you can see that you are talking about scenario one. You are talking about this scenario one, where the stock price is 70 rupees and the strike price is the 100 rupees. So basically, I covered all the three scenarios which are possible in the market. In all the three scenarios in the market, these three conditions which we derived remain same always. So these three conditions always same. Number one, this put call parity always hold, and the call option is always greater than S not minus K, and K can be replaced by K e to the power minus RT, because in European call option it is the present value of K. So spot price minus present value of K is the minimum value of the call price. Similarly, for a put, the minimum value of the put price is K minus S. So three equations which we draw from this example is this. Otherwise, it is very difficult to understand the logic of put call parity. Okay, now let me move to the slide. So in this slide, I mentioned all the cases, all the three cases. So you just go through this example, and you know that we can draw the put call parity example from here. So the conclusion is for a European call, the lower bound means the minimum price that could be possible for a call option is this. And minimum, you know that sometimes the value of the call option cannot be negative. Call option cannot be negative. It minimum value is 0. Call value or put value cannot be 0, cannot be, sorry, negative. Minimum value is that when you are not executing this. So minimum value is either 0 or this value. So whatever be the maximum value in the two, that is the lower bound of call option. Similarly, in case of put option, we also draw this, the minimum possible value for a put option. So after this example, one thing is very clear. So what is the upper bound for a call? That is spot price. What is the upper bound for a put option? That is the strike price. And what is the lower bound? The lower bound are the, we estimated, we derived with the help of example. And we also derived put call parity, because by comparing the portfolio 1 and portfolio 2, portfolio 1 is this and portfolio 2 is this. So by equating the portfolio 1 and portfolio 3, so we are writing this equation. So whatever be the market, whether the market come down, whether the market go up, whether the market remain constant, C plus K e to the power minus RT will be always equal to P plus S naught. So by comparing this, we derive the most important equation of the derivatives, which is known as put call parity. Now the problem, not a problem, it is one of the important features of the market that whenever this equation don't hold, whenever the actual price of the call or the actual price of the put is different from this equation, so this will give you the arbitrage opportunity, and that arbitrage opportunity is the opportunity by which you can make profit very easily. So let's do one example of that. Okay. So the common things that we remember is that consider the following two portfolios just discussed. Portfolio A is the European call option on a share, present value of the strike price of the share in cash. Portfolio C, which according to the, for example, put plus share, and both the portfolios are worth this at the maximum maturity of the put options. So this equation is known as put call parity. Now the benefit of this put call parity is because valuation, whenever we talk about the valuation in the markets, there are two directions of the market. One is the forecasting and one is the valuation. So at this time we are not doing any kind of forecasting, rather we are discussing the valuation aspect. And the valuation aspect is developed on the theoretical basis that and in derivative, one of the theoretical background is the arbitrage opportunity. All the valuation are possible in such a way that there is no opportunity for arbitrage. So assuming that there is no arbitrage, this opportunity hold, and in case the put call parity don't hold, so how we can take the benefit of put call parity? Let's discuss that. And arbitrage is simply the differences between the two markets, or it is the benefit of the mispricing. Benefit of the mispricing. Now there are two examples, two cases. This is the data set, right? So in this data set, we have to find out that what are the different arbitrage opportunities. So I am taking this data set in the Excel and tell you that how we can identify the arbitrage opportunity. So taking a new sheet. And the put call parity I'm also taking. So first of all, because these type of examples you can face in the exam, and this is the equation of put call parity. So first of all, if you check the values, so call option is given as 3. Put option is not given, so we will keep it X. We have to calculate it. Or basically it is a question mark. and the time to maturity T is equal to 3 months. It is 0.25 to 0.25 means the one fourth of the time, and for 1 year 1/4 means 3 months. The risk-free rate is equal to 10%, and the dividend is 0 by default. Okay. Yeah, strike price is also required. Strike price is 30. So with this data set, first of all, we have to calculate the value of the put. So the put can be calculated by applying this formula. So put is equal to call minus, and S naught is 31. Or S naught is also given. It is 31. So let me write S is equal to 31. Okay. So this is P equal to C minus S naught plus, what is K? 30 multiplied by e to the power minus RT. So E means exponential, EXP exponential, multiplied by minus RT. So minus R is 10% multiplied by T is the 0.25. So in this way, we can calculate the real put price. This is the answer of the put. So this, if we assume put call parity, the price of the put should be 1.25. Okay, now the let's take to 2 decimal point just for comfort. Now the question is that if the actual arbitrage opportunity is the actual price of the put is 2.25 and put equal to 1.00, how we can make the arbitrage opportunities? The question is that how we can make the arbitrage opportunities. So we can divide the answer into 2 cases. The case number 1, when the put is overpriced, and the case number 2 is when put is underpriced. So in first case, the put is overpriced, the put value is 2.25 and the actual value is 1.25. So it is overpriced. And in second case, it is underpriced. Now the question is that what could be the arbitrage opportunity? So for that, we are having a formula. And let me explain you the formula first. Where is the Excel file? Yeah. Okay, so in first case, the arbitrage opportunity can be mentioned by buy A, sell C, means buying the portfolio A and selling the portfolio C. And in second case, we can take the benefit of arbitrage opportunity by selling the portfolio A and buying the or taking the long position in portfolio C. So if we solve this formula, we can get the arbitrage opportunity. So let me show you the solution of this, and we can calculate very easily. Okay, so now the first case is when the put option is relatively overpriced. In this case, the opportunity, the strategy should be, so take a long position in C plus K to the RT and selling the portfolio C, which is P plus S naught. The value is calculated here. So arbitragers will thus buy securities in portfolio A and short the securities in portfolio C. Means in portfolio A, we are having the call option and the zero coupon bond. So buy the call option, and zero coupon bond means investing cash in the risk-free security, risk-free rate, and you are selling the portfolio C, means you are selling the put and selling the stock, shorting both put and stock, generating upfront cash flows of this, right? So this is the cash flow you will get immediately, and you will invest into the risk-free rate, and you will get $31 per in 3 months, time assuming the time period of 3 months. So this is the value of K. Now at the expiration, whatever be the condition, your net profit is $1. So 31.02 minus 30. So whether the market will go down, whether the market will go up, your riskless profit is $1. Similarly, when in case the put option is underpriced, the value of the put option is underpriced. So we are reversing the strategy. So we can sell the A, we can sell the call option, and this zero coupon bond, and we can buy the put option and one of the stock. So if you do this, the investment, the riskless profit you can make is 0.27. If you calculate the values of portfolio A and portfolio B, as we calculated in the example in the table, we can calculate the values of both portfolio A and portfolio B, जो हमने table में भी calculate किया था. So the difference between the two portfolios is the profit. So in this case, you can make the profit of 0.27. So in this way, we can take the benefit of the arbitrage opportunities. Although getting the arbitrage opportunity is very risky. Why? Because these opportunities comes in the market for a very short period of time, and if you do it manually, it may be possible that in that period of time it will disappear. So the problem with the arbitrage opportunity is that they are not remain in the market for a long period of time. It appears for a very short period of time, and if you are not having the algo trading softwares, it is just impossible to take the benefit of these opportunities. So this is the topic for today that we want to cover, and 3 things we covered in today's session. So that what are the factors which are influencing the option price, and what is the nature of a relationship between the two markets, option and the stock. And then we discussed the upper bound and the lower bound of the stocks, of the options. So what could be the maximum price of a call option? What could be the minimum price of the call option? What could be the maximum price of a call option? What is the maximum price of a put option? And how to derive the put call parity equation from this. And if you understand the put call parity, and the value of the put or the value of the call is not as per the put call parity, it means you can make the riskless profit from the market by arbitrage opportunities. So this is the decided topic for today. I think that's clear, and these equations will also helping you to understand the advanced topics in the options, especially when you move to the Black-Scholes option, Black-Scholes model for the option pricing. So option pricing, you can also see it is a combination of a spot, the strike price. So basically, if you see this equation carefully, C S naught ND1 K e to the power minus RT and D2. So somewhere it is closer to the put call parity, and here S naught is the stock price, and ND1 is basically the delta. In this equation, ND1 is representing you the rate of change of call price with respect to the spot price. In simple language, it is representing the relationship between the spot and the call option, represented by the delta. Similarly, K e to the power minus RT is representing the present value of the zero coupon bond. So it is nothing, it is a zero coupon bond, and because it is a minus, it is because minus, so minus means you are taking a short position in the zero coupon bond. And ND2 is basically the probability that the call option will be exercised. So ND2 is the normal distribution of the D2. D2 is the distance to default. Distance to default means how much distance is there when the call option will not be exercised. So in short form, ND2 can be defined as a probability that the call option will be exercised. Similarly, n minus d1, if you, or n minus d2. And d2 is the probability that call option will be exercised, and minus d2 is the probability that call option will not be exercised. So somewhere it is, this equation is related to the put call parity equation. So that's why understanding the put call parity equation is important for the valuation models. And most of the valuation models are based on no arbitrage concept. So I think that's it from my side. And if you have any query, you can ask. क्या हुआ?